Today's tutorial is on moving averages, what they are, how they work, and how you can benefit from them. There are only two basic types of moving averages. One, a simple moving average, and two, an exponential moving average. The main difference between these two moving averages is that an exponential moving average places greater weighted emphasis on the data series that's closer to the end of the series. To construct a moving average, you simply add the closing values of any market for the past XX days. You then divide that total by a similar number of XX days, which in turn gives you an average, smooth that value for the XX days. This is then the next day's value for the average on a chart. Moving averages are normally shown as simple, smooth lines on a chart. An exponential moving average is pretty much the same process, except more emphasis is placed on the latter data. There are three ways to benefit from using moving averages. One, there's the price crossover method, which I'll show you. Two, the moving average crossover method. That's the golden cross. And three, support and resistance. Now let's go and take a look at all three methods in action. What we're looking at is a close-only price chart, and we're going to put a simple moving average on this price chart. So go into On-Chart Studies, just click once. You have a drop-down menu, and then choose Simple Moving Average. And for our purposes, I've already pre-selected a 200-day moving average. That's a standard longer term. Now, if you move this around, you can see how you can actually manipulate the moving average if you wish. That's called form fitting. You click once and you can see that the moving average prices have been below the moving average and then moved over the moving average. Now some traders actually trade when the market goes, the prices fall below the moving average like they did here. They'll go short or get out of the market more than likely, and when it goes over the moving average, they tend to get long. But it's actually a better method, a more confirming method, and that is the moving average crossover method, or the golden cross. So I'm going to put another moving average on here, but it's going to be an exponential moving average, and that's going to be right here. Click once, and I'm going to select 50-day exponential moving average. You can put as many moving averages on a chart as you wish, but we're just going to use these simple two moving averages. One, a 200-day moving average, simple, and a 50-day exponential moving average. Now the theory behind this is when the red line goes below the green line, then that's a change in the trend and you should be out. And as you can see, it worked very, very well here. And when it crosses over, then you should be a buyer and you should stay in until the cross goes the other way. It's called a golden cross. There's a lot of people who follow this and believe in it, and it works longer term. You don't buy the bottom and you don't sell the top, but you get the big fat part of the move. Now the other thing that moving averages do, they can help you with resistance and support areas. Now look at on this exponential moving average, you can see how the resistance hit the resistance here, and finally moved around there and then came back up and then acted as support. And that's one of the other things they do. But I think there are better tools to use resistance and support areas on charts. But that's how simple and exponential moving averages work. I hope you've enjoyed this tutorial.